a gap of almost 4 years, defense PSU Hindustan Aeronautics is now trading well above its issue price of $12.40 a share. The stock had a dismal performance because of lower execution and other issues related to capital allocation and use of surplus cash. Also, market expectations were trimmed from the time the company went public in 2018. From 2018 to 2021, its revenue grew merely by 7% annually, despite the huge order book and government's emphasis on the sector. While growth has moved up marginally, delivering a 9% year-on-year growth in the first 9 months of the current fiscal, the sentiment around the sector and a few recent developments, such as the Defence Ministry issuing the third list of imported defence items for indigenous production, comprising 101 items in addition to 108 items notified in the second list and 101 items notified in the first list, led to spike in share prices. The stock has jumped from a low of around 670 rupees a share in November last year to the current levels of 1670 per share. While the long-term structural opportunity remains intact, considering the recent spike in share prices and valuation, investors should exercise caution. The stock is currently trading at 16 times its FY23 estimated earnings, with a dividend yield of around 2%. Notably, valuations also look rich from earnings growth perspective, as well as uncertainties over the availability of equipment and other supplies from Russia. A large chunk of its current orders is going to be delivered in FY24 and 25. Prior to that, the growth is expected to remain in single digit or very low because of lower execution. Hindustan Aeronautics manufactures aircrafts, helicopters and passenger aircrafts largely for the Indian defence sector. The company is currently sitting on an order book of about 80,000 crores, which is over 4 times its FY21 annual revenue. Moreover, the third list of notified imported items could offer good opportunity. It could potentially offer orders worth 2.1 lakh crore over the next 5 years. This also includes the naval utility helicopters and few others with the estimated value of around 20 to 25,000 crores of possible orders for HAL. That apart, recently in consortium with L&T, HAL has emerged in L1 to make 5 PSLVs for Israel. In recent times, it has also signed an MOU with Israel Aerospace Industries to convert civil passenger aircrafts to multi-mission tanker transport aircraft. Overall, in light of these developments, the order visibility today has significantly improved. As against the current order book of around 55,000 crores, the company has indicated that it intends to cross 1 trillion mark by next year on the back of these developments in large orders such as Tejas. But as mentioned earlier, the execution of orders is going to be back-ended, and most of these orders will only reflect from FY24 given the completion schedule and execution. For instance, the deliveries of 48,000 crore worth of Tejas orders will only start after 3 years from now. Overall, while the visibility is improving on the back of growing order book and strong pipeline, poor execution and low growth in earnings in the medium term could hammer the stock, particularly in light of the stretched valuations. It's a good buy on dip stock that will require a lot of patience as the story unfolds.